Hello, good morning to all. Welcome to today's Daily Dose of Market Insights by OANDA. I'm Kelvin Wong, the Senior Market Analyst of OANDA Asia Pacific. Good morning. Today will be Thursday, 14th of December. So before we start, as usual, let's take a look at the disclaimer slides first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. And as well, this advertisement has not been reviewed by the Monetary Authority of Singapore. Okay, so let us start with what happened overnight. All right, so we know that yesterday during the late US session was this all-important FOMC meeting, which is market has really been expected no interest rate hike nor interest rate cut during yesterday meeting. That means the Fed will actually be expecting to stand pat to keep interest rate at 5.25% to 5.5%, the Fed fund rates. But what's important over here is the guidance that's being portrayed by Fed Chair Powell during the press conference, and as well as more importantly, the dot plot. So yesterday's what Fed Powell actually portrayed over here is a rather dovish pause. That means, i.e., we are for sure now a very high chance, I would say high chance, that the Fed fund interest rate hike cycle that took shape around 2 years ago has already ended. That means we are now looking at a terminal Fed fund rate at 5.25% to 5.5%. And the next step for the Fed, what they're going to do next over here is they're going to actually start to actually enact interest rate cut cycle. So that actually induced a very strong risk-on behavior across the board in the entire US stock market. So later we'll talk about more about the market's perspective. Firstly, I will share with you all the projection of the dot plot over here. Why does it lead to a risk-on behavior yesterday? Okay, so let me shift my screen to this one over here. Okay, so what I could see on my screen over here, this is the dot plot. Okay, so this is the latest dot plot. So what is dot plot? So dot plot is actually, they will not release it in every FOMC meeting, subsequent one. So the last release was in September. So yesterday's will be the latest dot plot release. So dot plot release is in fact key economic indicator in the US that being forecasted by Federal Reserve officials in the next 3 years. That means 2024, 2025, and 2026. Okay, so let me share with you the most important market participants looking out for is the potential trajectory of the Federal Reserve Fed funds rate. Okay, so all this one over here that I highlighted on your screen over here is the one that's the latest one that's been released yesterday. September projection was the previous one. So what it means that over here for sure, yesterday 5.4%, the Fed fund rate for 2023 5.6%. So it clearly indicates to us that the current Fed fund rate is 5.25% to 5.5%, the upper limit. So this is the current Fed fund rate is the terminal rate at the current interest rate hike cycle. What's interesting over here is that they projected lower Fed fund rate at 4.6% in 2024, much lower than the previously projected one in September at 5.1%. So what it implies over here is that it implies that in 2024, the Federal Reserve official is actually projecting at least 3 interest rate cut of 25 basis points each. If you do the maths, all right, that's 75 basis points away from 5.4%. Okay, so that actually explains a dovish pause guidance as portrayed by the Federal Reserve officials thinking that induces the risk-on behavior yesterday, where we see the US stock market rallied, the US 10-year Treasury here break below the 200-day moving average, and dollar weakened across the board. Okay, so we got to respect this ongoing positive flow, at least in the short to medium term, despite the fact that we know that next year there could be a higher chance of a US recession. Why do I say a higher chance of US recession? in order for the Fed to be so aggressive in portraying the trajectory of the future interest rate in US, that means taking care of the Fed fund rate by projecting 3 interest rate cut instead of 2. So the only way for the Fed to have 3 interest rate cut over here is we need to see CPI to come down, or PCE data. They actually look at PCE inflation. So core PCE inflation, definitely they're actually looking at to come down much lower, 2.4% versus 2.6% as projected in the September dot plot, 2.2% in 2025 as slightly 1 basis point lower than 2.3% in the September projection. So if think about it over here, is that the only way PCE inflation or inflation pressure can come down is there is lesser demand in the US economy. So lesser demand in the US economy got to be induced by a recession scenario, potentially, rather than a soft landing scenario. So sooner or later, this particular projection over here will start to filter down to earnings announcement, where we come out in either Q1 or Q2 next year. When that actually happen over here, market participants will actually revise down earnings growth of US corporation. So this is where potentially we may start to see a much more corrective pullback or substantial corrective pullback in the US benchmark indices. But for now, the US benchmark indices is now being supported by seasonality, Xmas rally, and as well as potential risk on flow, liquidity that's being supported by the 10-year US Treasury yield that still has some more potential to hit much lower towards the next key support level. Later I'll flash you the 10-year Treasury, 10-year US Treasury chart. So all in all, this potential, we call it a bullish trajectory that we see right now in the short to medium term could potentially last into Q1 next year. Okay, so we still got to respect the flow despite the fact that there is a higher chance of a recessionary scenario coming into play into US, given the kind of trajectory that's being portrayed by the Fed Fund latest dot plot. Okay, so I hope that I could make myself as clear as possible. So now, state of the market. Okay, so if you look at the US state of market, the Dow Jones Industrial Average. Okay, let me share with you all. Share my chart. Yes, so this is the Dow Jones Industrial Average. Okay, previously the all-time high was at 36,952 printed on 5th Jan 2022. Okay, yesterday it actually cleared above the all-time high. Okay, so let me pencil put it so that you guys could see here. Okay, dotted in black. Okay, it clears above all-time high. And do not forget, yesterday's risk-on rally, a clear risk-on rally due to this triggered by this major risk event, which is the release of the latest dot plot, is being led by the Dow Jones Industrial Average. As we know that Dow Jones Industrial Average is not a leading benchmark US index in this ongoing major uptrend that took shape in late October 2022. That was a year ago, all right? The leading one is led by the Magnificent Seven, which is heavily weighted in the Nasdaq 100. So if you look at the Nasdaq 100 yesterday, yes, it rallied as well. In terms of momentum-wise, it still hasn't reached its all-time high yet at 16,765, which is about 1.15% away. All right, then you have the S&P 500, which is also similar at 2.34% away. The Russell 2000 small cap stocks over here, the one that rallied the most because of a lower base at 3.52% today, is still 26% away from its current all-time high at 2458 printed in November 2021. Okay, so what we could see yesterday, leadership rotation of the benchmark US indices is being led by one of the laggard, which is the Dow Jones Industrial Average. That is the first one to make fresh all-time high instead of the Nasdaq 100. So what does it imply? It actually implies that the movement that we see right now is a late cyclical rotation, leadership rotation back into the laggards the largest benchmark stock indices. That means a shift away from leadership on Nasdaq 100 to Dow Jones, and potentially later down towards the Russell 2000, due to the fact of this optimism in we call it liquidity loosening in US, but with the fact of that we are at the pointing at the wake of a potential recession scenario next year. So it's more like a late cyclical we call it a point in time of this major bullish trend that is being seen in the major US stock indices, or i.e. the US stock market, in place since late October 2022. Okay, so this is the key highlight we shared with you yesterday. All right, so now back to the short-term technical outlook now. Okay, so let's now dive deeper into the short-term technical outlook. Okay, so short-term technical outlook, that means we are talking about 1 to 3 days time horizon, or instead of a very bigger macro picture. Okay, let's start with the benchmark US stock indices first. All right, so with that, let me expand my screen by hiding myself. All right, okay. Okay, start with the Nasdaq 100. Okay, so for Nasdaq 100 over here, yesterday, or in fact the start of this week, we do have the bullish bias, given the fact of the change in that positive element at the start of this week, early part of this week. So with that, it cleared above 16,590 yesterday. That's the resistance level that we have. Upper resistance level coming up next will be 16,770. So that's the all-time high as being printed in OANDA's platform, 16,770. And followed by a Fibo extension cluster at 16,950/16,990. At this moment in time, yes, we may start to see this push up in price. It's a bit overstretched on the upside, but this overstretch on the shorter term, it portrayed by higher high on the hourly RSI as well. That means the hourly RSI is not flashing any lower high. That means it's not flashing something like this. That's a bearish divergence. So it's not showing any bearish divergence. Yes, it's overbought, so potentially there could be a pullback coming into play towards maybe 16,590 area and 16,490 area. All right, so I'll be using 16,330 as my Titan key short-term pivotal support level, which is very close to yesterday's yesterday US session swing low ahead of the release of the Fed dot plot, which is 16,386. And if we do a Fibo retracement from the entire minor short-term uptrend phase since the low of 4th of December 2023 is also close to 38.2% as well. Okay, so I'll be using a rather tight short-term pivotal support for today, 16,330, to maintain that short-term bullish outlook on the Nasdaq 100, with the next resistance coming in at 16,950/16,990 after a potential break above the all-time high at 16,770. However, if we start to see a breakdown below 16,330, then we may start to kickstart a minor corrective pullback towards 16,160 slash 16,090, okay, which is all confluence with this upward sloping 20-day moving average. Okay, Dow Jones Industrial Average, US Wall Street 30, we call in our platform. So in our platform, this is the former all-time high at 36,890 slash 36,977. So 36,977 is the former all-time high as printed in the OANDA's platform. Okay, so yesterday since the start of this week, we do have this 36,890 as my resistance level in our short-term bullish outlook. So it cleared above this level, pierced above the upper boundary of this ascending channel that I draw from the low of 10th of November, indicating to us that there is this acceleration of this short-term uptrend move. RSI is at the kind of an extreme overbought level on the hourly chart. You could see over here. Okay, so it comes to reach of a kind of an extreme overbought level over here at this point. All right. So view it as something like as a momentum upside resistance. But yes, we know that momentum upside resistance kind of reach extreme overbought level. But while it's trying to shape this push up in price action, the RSI didn't shape any bearish divergence. That means it continued to shape higher high that move in line with the price action. So what we could see over here is that potentially, yeah, we may see a bit of pullback back towards the former all-time high area at around 36,977 slash 36,890. It's kind of pullback. But as long as this pullback managed to help above this short-term Titan pivotal support level that I have for today, 36,655. Potentially, this short-term bullish outlook could potentially remains intact, with the next intermediate resistance to come in at 36,800, which confluence with a Fibonacci extension level. Okay. However, if we start to see an hourly close below 36,655, then we may start to translate into a minor corrective pullback scenario to kind of test 36,250, followed by 35,925, which confluence with the upward sloping 20-day moving average. Okay, over here. All right, that's 36,960. Pardon me. All right. So all in all, still maintaining that short-term bullish outlook on the Dow Jones Industrial Average / US Wall Street 30, with a potential pullback scenario first coming into play. But as long as this pullback scenario managed to hold above the 36,655, the bullish impulsive move may resume within this short-term uptrend phase that is still intact. Next intermediate resistance to watch will be at 36,800. Okay, so that's the short-term outlook for the benchmark US indices. Okay, now European indices, German 30. So given this kind of a very strong risk-on behavior that's been exhibited in the US market yesterday, initially we do have a short-term bearish bias on the European indices, which is using German 30 as a proxy, holding below 16,930, but it got to break down below 16,735 before exposing 16,590. So yesterday, ahead of the US, right after the release of the dot plot, yeah, it tested 16,735. So that was the downside trigger level. But after that, it did a short reversal above the downside trigger level. Okay, so since it didn't break below that downside trigger level that we highlighted earlier, we cannot be sticking to our short-term bearish bias anymore. And in fact, we got to now flip with a bullish bias given the strong price reaction that was seen on the German 30, and upside momentum also start to revive back into the market by breaking below this former bearish divergence, which is a kind of a descending trend line resistance on the hourly RSI, and a clear break above it. Okay, so with that, I'll be using 16,735 as my key short-term pivotal support level. Potentially, there could be a pullback coming into play to retest yesterday minor swing high area at 16,850, now turns into a pre-pullback support that I highlighted on my chart over here. So as long as the pullback managed to hold above 16,735, that's our short-term pivotal support we have for today, flipping to a short-term bullish outlook on the German 30 index towards 17,100. That will be the next intermediate resistance, which confluence with a cluster of Fibonacci extension level, and as well as the upper limit of this ascending channel that is in place since the low of 27th of October. Okay, only an hourly close below 16,735 will revive back that corrective pullback scenario, heading down towards 16,590. Potentially a break below 16,590 exposes the next support at 16,440, which is also confluence with this upward sloping 20-day moving average. Okay, Asia indices, Hong Kong 33. So Hong Kong 33 also managed to catch that bullish, we call it a bullish risk on behavior scenario. Attempt to pierce higher during the first hour of the Hong Kong trading session a while ago, holding above 16,100. So that's our key short-term intermediate support level we have yesterday. So with this very strong push up in price action, I'll be using this 16,100 level as my key short-term pivotal support for today on the Hong Kong 33 index, which is Hang Seng Index. Okay, so as long as 16,033 holds, break above 16,550 potentially exposes us the next intermediate resistance to come in at 16,890, which is this minor cluster area of 29th of November and 4th of December, confluencing with the 38.2% Fibonacci retracement of that previous short-term decline from 16th of November high all the way down to the 9th of December low, as well as confluencing with this short-term 20-day moving average that is downward sloping at 16,890 as well. So is it the start of a much more pronounced bullish reversal from a multi-week perspective on the Hong Kong 33? No, at this moment in time, there's not enough clear element yet, because price action is still below the 20 and the 50-day downward sloping moving average. All right. So, but however, if we start to see a breakdown today below 16,100, then this short-term bullish outlook will be invalidated on the Hong Kong 33 to see another round of messy, we call it a choppy downward move to test the next support level at 15,890. Okay, so that's the outlook for the Hong Kong 33 index. So all in all, in the short-term perspective, we are having a potential short-term bullish bias across the board that I share with you on the major stock indices. All right, FX market now. So let us start with, before I start the FX market, let me share with you all, this is the dollar index. So dollar index, for sure, we start to see a very bearish reaction right below the 184.40 intermediate resistance, and also breaking down below its 200-day moving average, indicating to us that we are now in the midst of a medium-term downtrend phase that is in place since the high of 1st of November. Supported by what? Supported by a breakdown below the US 10-year Treasury yield, breaking below the 200-day moving average, which is at the 4.6% level formally. Next support level to watch out for will be at 3.6 and 3.3, which is the swing low area of 24th of March all the way to 4th of May this year, this area over here. So if you look at the current trajectory of the momentum of the US 10-year Treasury yield, it seems to us that it still has ample move to move down towards the downside before any meaningful rebound takes shape, at least at 3.6. So i.e. that actually supports the loosening of the liquidity condition globally. All right, before market participants starts to get aware of that recession scenario, start coming back in towards the later part of Q1 next year. So that actually explain why my earlier macro view over here is that we are still having that potential risk on impact, but it's being supported by a loosening of liquidity condition. But however, if market scenario start to realize that a recession scenario is creeping back into the picture, potentially earnings growth got to get downgraded, so that could actually have a negative knock-on effect in the later part of 2024. Okay, FX market short term. Euro dollar first. So euro dollar, since the start of late last week, we have that bullish bias holding above 1.070 short-term pivotal support. Then yesterday we push it up higher due to a much more positive element coming into play. So with that, price action start to shape higher low. So for sure now it already broke above 1.09. That is our short-term resistance that we highlighted yesterday. So and also back above the 20-day moving average. So all in all, what we could see over here is a revival or short to medium-term uptrend in the euro dollar. So with that, we will have a tightened key short-term pivotal support for today, 1.08. So 1.08 will be our short-term pivotal support. Potential pullback, it may pull back slightly around 1.082, and bear in mind later I'll share we have a risk event that's out in Eurozone today, which is the ECB meeting as well. So as long as the pullback managed to hold 1.078, so that is, I don't put it so tight at 1.082 due to this upcoming risk event in ECB meeting later I'll share more about that. So using yesterday US session low and as well confluencing with the former swing high area of 11th of December, and that turns into a pullback support yesterday that managed to help right after the release of the Fed pivot, not Fed pivot, the Fed dot plot. 1.0780 tighten key short-term pivotal support level, maintain that short-term bullish outlook. Next resistance to watch out for 1.096, a break above it takes us up to 110.40. So what's 110.40? So 110.40, if we go back to the past, is in fact the minor congestion area of 26th of July, rejected, tested on 10th of August before it dipped that prior minor corrective decline, okay, on the euro dollar. So only a break below 1.0780 will negate our short-term bullish outlook to see a retest of that 50-day moving average that is outward sloping at 1.07. Sterling dollar, similar as well, price hit that 1.2610 level and clears up above it. So I do not want to use 1.2610 level as my key short-term pivotal support for today. Instead, I will use this minor descending trendline resistance broken up during the US session yesterday, now turns into a pullback support at 1.2545. So bear in mind over here is that we also have a risk event happening in UK today, which is also the BOE, Bank of England monetary policy decision later as well. So 1.2545, 12545 will be my key short-term pivotal support for today on the sterling dollar. So as long as any pullback managed to hold above 1.2545, potentially the short-term bullish outlook remains intact to at least see a retest at this minor range top of 29th of November and 4th of December at 27.30, 1.2730 resistance. Only a breakdown below 1.2545 will negate or invalidate this short-term bullish outlook to see a reversion back to a very choppy corrective decline, minor corrective decline scenario toward 12550 / 12460, which is the 200-day moving average, and confluencing with the medium-term ascending trendline support that is in place since 1st of November. Asia Pac currency, major currency, let us start with the dollar yen. So dollar yen, we have been looking this bearish upside since late last week with price turns weak. Price actually moved within our expectation. So what I could see over here right now is that price actually revert right at our 146.70 key short-term pivotal resistance that we have after anticipating that minor corrective rebound that takes shape. That is the end of the minor corrective rebound. Right now, what we're seeing over here is the resumption of this short-term bearish trend that is in place since 13th of November high. Okay, so now it's really breaking below the 200-day moving average, attempting to challenge the swing low of 8th of December at 142, 141.60. Next support level to watch will be at 139.20. So what's 139.20? If you go to the 4-hour chart over here, is in fact this congestion area of 17th of July and 28th of July this year. Okay, and as well confluence with close to the 50% Fibo retracement of this former medium-term uptrend from 16th of Jan all the way up to November high this year. Okay, so that's the former medium-term uptrend. So right now we are now transiting into a medium-term downtrend on the dollar yen. Okay, so this is what I want to express for you all. So now we want to take things one step at a time, because this is an hourly short-term technical outlook. Yes, RSI now is at the oversold level, but no bullish divergence like what we see previously. So what we could see over here is that potentially it could actually inch much lower. Given the fact that this is a very steep down move, I don't want to use anything that is in between as my key short-term pivotal support for today. Key pivotal short-term resistance for today. Potentially we may see a bit of, we call it a snapback, a pullback or rebound to correct this oversold condition that's being flashed out on the hourly RSI. So the snapback rebound potentially could actually take shape around this area here. Okay, this congestion area over here. Okay, this minor swing low area. Okay, let me share. Okay, yes, 143 around this. 1 minute, sorry, yeah, this level, yeah, this level, this former swing low breakdown now turns into a pullback, minor pullback resistance at 143.30. Yeah, so 143.30 will be like a level for its pullback rebound, but I don't want to put it so tight over here. I will use 144.80. So 144.80 over here is that very clear former minor swing low before that steep slight take shape. And if you do the Fibo retracement over here, it also confluence with the 76.4%. So as long as 144.80 holds for any snapback potential rally to correct, to actually correct, to revert this oversold condition on the hourly RSI, potentially the bearish outlook still remains intact on the dollar yen towards the next support level at 139.20. Only an hourly close above 144.80 could potentially see the start of another minor counter trend rebound towards 146.70 / 147.40, which is the minor range top of 5th of December and 6th of December, and also confluence with the downward sloping moving average. Aussie dollar. So on the Aussie dollar over here remains bullish as per indicated in our previous outlook. So with that, hourly RSI now is at the extreme overbought level. So potentially it could work out this extreme overbought level by shipping a minor pullback. So pullback over here potentially could come around this region over here. Okay, at 66.70. So I don't want to use 66.70 too tight as my short-term pivotal support. Instead, I will use this very clear former swing high. Now turns into a pullback support. We're also confluencing with the upward sloping 20-day moving average at 66.20. So as long as 66.20 holds, potentially the Australian dollar could see another maintain this short-term bullish outlook towards the next intermediate resistance at 67.40 / 67.90. 67.90 is pretty important. Why? Because if you look at the daily chart on the Australian dollar, 67.90 is in fact this major descending trend line all the way up from 25th of February 2021 high over here. Okay, so a clear break of this 67.90 level potentially could give birth to a we call it a very much more substantial medium-term uptrend on the Australian dollar. But in the first step, in the short term, we are using 67.90 as the intermediate support to watch in our short-term outlook. Okay, on the Australian dollar. So only a break below 66.20 will invalidate the short-term bearish outlook to see a choppy a decline back towards this level here, the 66.55/65.20 level at this point in time, which is this for base low, this ongoing medium-term base low, okay, that being portrayed in the price action right now. Okay, with that, gold as well. So gold also managed to actually benefit from it. So gold, still recall yesterday we have bearish, but our bearishness is more on the residual push now because we are expecting the tail end of this medium-term corrective decline that is in shape since the current all-time high that was printed in 4th of December. So yesterday's swing low was at this 1973, slightly above 1965, our target. So price action actually pierced up and broke above the pivotal resistance that we have yesterday, 1997. So yes, RSI is kind of an overbought level right now on the hourly extreme overbought level, but no bearish divergence. So potentially we may see a bit of pullback to work off this extreme overbought condition on the RSI. Pullback level 2017, which confluence with the 20-day moving average, but I don't want to use 2017 as my short-term pivotal support for today. Give a bit of breathing space. 1997, so it's very close to the 2000 psychological level. So as long as 1997 holds, flip back to a bullish bias on gold XAU/USD, potentially to resume its medium-term uptrend phase that is in place since 6th of October. Next resistance to watch in the short term will be at 2067. All right, so now then followed by 2026 next, okay, 2126 next. Okay, so that's gold. So only a breakdown below 1997 will start to see a messy choppy movement down towards the next support area at 1965/55, which is the upward sloping 200-day moving average and 50-day moving average as well. So all in all, even though price starts to break down below 1977, the next support level is about 1965/55. If this level managed to hold, the medium-term outlook still remains positive on gold XAU/USD. Okay, now oil price. So oil price over here yesterday, we have a neutrality bias between this 70.50 and 67 figure level. So still no change. Price action is still expecting to trade sideways between these two upper boundary at 70.50/67. Only an hourly close above 70.50 potentially could trigger off a potential minor corrective rebound scenario in first step towards 72.40, 74.10, which is confluencing with the downward sloping 20-day moving average as well. So that's pretty much sum up with the short-term technical outlook. Now, very quickly, what are the key data to look out for today? For sure, like I expressed, okay, two key data will be the ECB meeting. So over here at ECB meeting over here for today, so today will be Wednesday, Thursday. Okay. Okay, so we have BOE first at 8 p.m. Singapore time, Bank of England, followed by ECB at 9:15 p.m. Singapore time. So bear in mind that ECB will also release their dot plot, but their dot plot doesn't take into account of the interest rate, the future interest rate, but it's more about the projection of future inflation trend in ECB. And also right now, market expecting BOE to actually see 100 basis point cut next year. So that's 2 interest rate cut next year starting in Q2. And also for the ECB side of the story, market is actually looking for ECB rate cuts as inflation falls from here. So market is especially also close to be rather dovish as well, all right, rather dovish as well in terms of the expectation of ECB to have to cut. Okay, let me highlight. Okay, so based on the interest rate futures, the Eurozone interest rate futures, market are just expecting ECB to start cutting in March, very similar to what market is pricing for the Fed, and followed by 4 more cuts into 2024. Okay, so that's much more, we call it dovish versus the US, given that the state of the economy in Eurozone is not as rosy as in the US, given the PMI data up by the Eurozone that is indicate to us we are in a kind of a stagflationary like scenario. Okay, so with that, today's come up a bit late, more 35, around 35-minute mark, because I need to explain much more in detail on the macro implication of yesterday's Fed dot plot. So I hope that you have a better understanding what to come, short term as well as medium term, towards the first half of next year. So with that, have a great day ahead, and we shall speak again tomorrow. Thank you.